Welcome everybody. This is the Thursday evening Viper Trading webinar. If you're here to learn about trading futures markets using the Viper tools, you are absolutely in the right place. First, we got to knock out our standard disclaimer before we can look at charts and trade setups. So let's take care of that right now. All communications from Viper Trading Systems are for educational purposes only. Futures trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. Okay, good. Good deal. Now we get that out of the way. I am going to start off with crude oil today. Got a lot of charts to cover, so let's not waste any time. Tonight's topic is scalps and runners can make you money. So let's get to crude straight away. Now, some of you are visiting for the first time. Some of you might be here on our open house, little program we had this week. Some of you are on free trials, and if I'm speaking to you, welcome to you, and I'm glad that you're spending some time with us. Let me quickly explain what you're looking at here. We at Viper trade futures markets, and we look to take advantage of short-term bursts in volatility that are contained within the window of usually around the first 2 hours of the trading session here in the States. So Gary, as you probably know, opens the live trading room at I think this is yesterday or the day before. Let me get you oriented real quick here. Yeah, this is yesterday. I'm going to look at a couple of different days this week to show you some different things to consider. So midnight yesterday was right here. So most of you know, of course, that the overnight session is this section right here, which is the Asian session up to midnight, and then the beginning of the European session starts at midnight Pacific, which is this line right here. You are looking at, we have a data feed. These is 4 range bar charts. This is what we use in the live room. I'm sure everybody's seen that. Each bar consists of 4 ticks of movement. Now, the indicators that we run against this data feed are called the Viper trading indicators. And you can see here that we have background colors, green, red, and this indeterminate transitional color. We have bar colors, red, yellow, and blue. We have power meters. These are various trends on the chart. When a market is in a very powerful, strong up or down trend, they will all be the same color. Green would be up, red would be down. We have the predictors, the swing levels in real time. And of course, the most prominent thing on here is the bands. So we have a thick line here is the mid band. A lot of our trades are centered around this mid band. We'll talk about that in a minute. Excuse me. Got a little tickle in my throat tonight. My apologies. And you have 1, 2, 3, 4 bands below it, and 5, 6, 7, 8, 4 bands above it for a total of 8, top and bottom. Line 2 is at the top. The thin red line is at the top of band 2. Line 6 is the green line at the top of band 6. So we can see here. And I've added 2 other things. These are not on the chart templates that we use in the live room. I've added current day, open, high, low. This is an out-of-the-box ninja indicator. I find it helpful. You don't have to use this. It shows the lows of the day are highlighted in the white dashed line when they're broken. The open line occurs, but everybody knows that markets trade 24, what is it, 24.5, 5.5, because they start all the markets open pretty much at 3 o'clock my time on Sunday afternoon and run through 1 p.m. on Friday. And then there's a slight pause in the markets from 1:15 to 1:30. So at 1:30 Pacific is the beginning of where this open line is. See the black line right here? This is the open line. And then right at the open, so for instance, this is the Asian session here. So you can see very clearly that the open of the session was here. The high of the session was established here with the blue line, and the low of the session is the white line right here. It's just something I find helpful, particularly if a market is breaking to new highs or it's breaking to new lows. The other indicator I've added to the template, which is not shown in the room, is volume up, down. This is another candle indicator from not from Viper, from NinjaTrader. You can put it on there. I kind of tuck it away. If there's a big move, it's associated with big spikes in volume, I'll take a look at it. It doesn't really influence the trade entries, though, just to be clear about that. It's just something I casually look at. Now, we know that markets can be in one of three conditions. And anybody know what they are? When I say market condition, what am I talking about? Market can be in one of three conditions. What would that be? What would the three conditions be that a market could be at any given point throughout the trading day? Whether it be overnight, pre-market session, European trading session at the U.S. market open. Yeah, let's go ahead and get that down right here. Let's get right on the chart so we're all getting off to a good start here. So we've got to know the current market condition, and so we know that markets can go up. Generally, that would define what's called an uptrend. And that means that we are normally looking to take long trades. We're buying the market, right? Markets can go down, which would be a downtrend, right? That would be a downtrending market. And so we are looking for shorting opportunities on rollovers, on retracements, and we'll show that in just a second here. Jack equals shorts, right? And then we can be sideways or consolidation, or there's different terms for it, which is also called range bound. That's another term for it, which means that there is a lack of, range bound, which equals a lack of trend. Now, you can be going what we call, and I'm going to explain this in a second, you can be going sideways to up, and there's a way to handle that, or we could be going sideways to down. And there's different ways that we trade that. All right, so let's look at times in the market where we try to define what the market's doing. So from my cursor to the left side of this chart to, say, over here somewhere, so that would be 5 in the morning on this particular day. This would have been, what's today? Thursday. So Wednesday was the 20th, 19th. Okay, so this is the 19th on crude oil. This is early in the morning to the left here. Market opens at 6. So that would have been right about here. Crude oil pit open, right? 6 a.m. It's right about here. So into the pre-market session, over here, way over here, in the early morning of the market, was crude going up, down, or sideways? U, D, or S, 5 seconds on the clock. I'm not going to give you a lot of time to answer this. So from here to here, was crude going up, down, or sideways? U, D, or S. 3 seconds left. Just type in a letter. Whoop. Up, down, or sideways? Crude oil. Now, we're not talking about trade entries yet. This is the first stage of seeing and taking trades, is you got to know what direction the market's going. You got to know whether you're going to be shorting it, buying it, or trading both sides or staying out, right? Okay, 2 seconds left, up, down, or sideways, crude oil on the morning and afternoon, late morning of the 19th. 1 second left. Cast your vote. Okay, squeaking in here at the last minute. It's pretty straightforward, I think. Okay, time's up. The market was down. Everybody got that right. The market was down. So we can see very clearly characteristics of a downtrend are a solid red background. The bars are predominantly red. The mid-band and all the bands are stair-stepping down, which constitutes a series of lower highs and lower lows. And so you're looking for shorting opportunities. Now, the way we trade it, I'm going to give you a high-level view, and then when we skip forward to this morning, we'll dive down and look at in more detail, granularity about actual entries. I'm just going to show a few things about how you trade a down market. So the concept that we have taught for many, many years is that markets, if they go into a trend, normally start with some sort of thrust. In this case, the downtrend is initiated with a thrust in a downward manner, as you see right here. Now, then you go into a series of what are called follow-on thrusts and retracements. So it is at this point, when the swing level is broken, that the background turns red. Okay, you can see that the mid-band is now red. You are breaking the lows of the day, evidenced by the white line being taken out here. So these are all fresh lows. Now, when you go into fresh lows, the mid-band goes into a red color, like such. See all the lows being broken all the way down, red mid-band, red mid-band. This is indicating fresh session lows. That's what the red mid-band signifies. So we're looking for shorts. So one of the things that I think is really helpful for traders to learn as a first kind of go-to trade is trading in and around the mid-band. So let's look at some mid-band trades. Here's a retracement where crude comes up right around the mid-band and just kind of sits here. See it? This would have been in the pre-market over here in the Northern California, 1:30 Pacific time. So you're just right in the middle of the European trading session. Obviously, there's a big sell-off on oil in the European session. Here's another kiss and roll. Each time, if you hear that in the live room, that's what we're talking about. Each one of these is an example of what we call a kiss and roll short, where you're kissing at or around the mid-band, you're rolling over and giving you short entry opportunities. I'm just going to highlight a couple of them here. You can see them all the way down. So you have this notion of thrust, retracement, thrust, retracement. And you can see we just continue that pattern all the way down. Here's another thrust, right? Here's a retracement. There's various ways. I'm showing the patterns of thrust and retracement and trade entries around the mid-band. Okay, good. Now, let's move on. How about, let's take a look at, I don't know, this area right here. Okay, I'm going to put let me put a line on the chart. How about this area right here? From here, this would have been 10:42 a.m. Pacific, and the line on the right. 5 seconds on the clock. Up, down, or sideways. From here to here. So this would have been into the close of the market, and then all the way into the Asian session right here. It's the beginning of the Asian session, or the end of the Asian session, the beginning of the European session at midnight Pacific from 10:42. U, D, or S, right here. And there's bonus points. There's bonus points if you can say, clarify more detail around what this is. And I've shown the various answers up here for you to consider. 3 seconds on the clock. Cast your vote. Cast your vote. What's going on in this area right here? 1 second left. Get your vote in. Okay, I see we're doing good. We're doing good. Everybody's getting this right. Got a big turnout here tonight. If you're coming in, don't worry. You've only missed about the first 20 minutes or so. We got a full hour, and it is recorded. We'll get it up on the web. Everybody can watch the recording. No problem. Don't sweat it. All right, time's up. The answer was, the first actual true factual answer is sideways. So everybody in here tonight got that right. So total kudos and gold stars to you. And a few of you typed in sideways to down, which was correct. Now, why would we call this area sideways to down? Any ideas? This area right here. In fact, I'll put a big old box around it. Sideways to down. What does that mean? Does that imply how you might trade it, maybe? If you said sideways to down? Look at the background colors. Look at what the mid-band's doing. What does sideways to down mean, and how might you trade it? So let's think about this intuitively for a second. Let's just look at this. Would you be, your primary mode of entry should be buying the bottom in sideways to down? So you're buying support here, right? Or would you be looking to short resistance, kiss and rolls, in a sideways to down market? So are these buying opportunities where you're getting long down here? Is that how you're going to get in? Or would you be shorting up here, taking shorts, kiss and roll short, kiss and roll short, kiss and roll short? What do you think in a sideways to down market? How are we going to trade that? Right. Sideways to down implies that you're shorting. So when the market gets down to support, you are buying it, but you are buying it to cover the shorts that you're taking from resistance. So these are buys only in a sense of buying to cover. Buying to cover wherever you're getting short from higher levels. You're covering your shorts down here. Now you're not getting long down here when you're sideways to down, because you're coming off, this is simply a distribution or consolidation area in a downtrending market. Okay, cool. All right, good. All right, let's advance this chart. We're still looking at the sort of the macro 20,000 foot level view. We're not really, we've talked a little bit about how to get short. All right, now I'm going to do a little exercise with you. We're going to recreate crude oil in real time going into the European session on the morning of the 20th. And I'm going to do this exercise as follows. When you think that there is a trend change on the chart, and I'm going to advance this thing in real time, you type in the letters TC. Okay? Are you ready? Okay, I'm going to show the chart as it was when you looked at it just a second ago, and then I'm going to gradually advance it through into the European session, and you type in, when you think there's a trend change, type in the letters TC. Here we go. All right, here's crude. There's crude right here. In fact, I'm going to blow it up a little bit. Let's make this crude a little bit bigger so you can see the bars real good. Oh, that's super big. There, that's better. Okay, good. Here we go. All right, starting the movement, we're reconstructing real time on crude. We're into the European session. Now remember over here, we were in a down, sideways to down, and of course you can see by breaching the dashed white line, these are in fact fresh session lows. Okay? All right, here we go. We're continuing into the European session. We're about a half an hour in right now. Okay, remember, if you think there's a trend change, you type in the letters TC. Okay, now we're about an hour into the European session. 1:15 a.m. Pacific time. There's 1:30. It's 1:32. Now don't worry, you're not making trade calls. That's not what this exercise is all about. You're looking for trend changes. You're not calling trades yet. We're at a very high level. This is a macro level, 20,000 feet. Just see if you can get a sense of what the market's doing. What is the market doing? Okay, keep it going. There's 2 o'clock a.m. Pacific, 2 hours into European session. All right, I'm going to stop it there. Now, I always love doing this exercise because it's interesting to see how everybody looks at this. Now, the good news is nobody typed in trend change when the market was down here. I mean, I think that was pretty obvious. You were still at fresh lows, and the background was red, stair-stepping down. You were continuing to in fact, this was the tail end of your short sales from up here, right? And you're covered right here. You're on a trail stop. Now, just to be clear, I think there was 1 or 2 of you that typed in a TC for trend change when the blue bars formed right here. Now, that was not correct. That was not correct. In fact, let me get my cursor on this so we're all kind of following along together. And look, if you're looking at this for the first time, or maybe you've only seen our charts a half a dozen times, you're just learning. Don't worry about it. That's why we have these sessions, so you learn, right? That's why we do this. So don't sweat it. So what happens here is that sometimes when traders see blue bars like this, they think that signifies a trend change. But notice here, at the time that they formed, from here to the left, what was still the background color? Over here. Still red, right? Still red. At the time that this box formed, let's recreate it. Let's go back and look and pretend we're looking right now in real time. Would you not agree that it is entirely possible that the market could break up from here or could break down from here? So just to be clear, this is not a trend change. That's not a trend change. Everybody sees that, right? All right. Now, what happens here is that we break up a little bit and we punch up higher. Okay, at this point here, what is happening what happened to the background color? And I'm going to help you out. I'm going to put a line for you. I'm going to put a line right here. In fact, let me make it a little bit bigger so you can see it real good. Maybe I should make it a different color so it shows up. Let me make it big. Let's make it like yellow or something like that so it really stands out. Where's yellow on here? Make it gold. Yeah, there you go. Good. What is the significance of this area right here, signified by this line? In other words, what was this area over here prior to this final push down like that? What was this area? What was it over here when it was bouncing off it like this? What was it? What do you call that? When the market comes down and bounces in the range, bounces in the range, bounces down, bounces in the range, and then breaks. It was support, which theoretically on a bounce off of a fresh low should provide resistance. Now, why is that important? Well, based on this move right here, did the resistance hold? Well, for a little while it did. When you were forming this little box here of indecision, where we didn't know, right? We just said a minute ago, we didn't know, are we going to go back down here or are we going to break up? Well, we got the answer. We got our answer. It broke up and it took this resistance level out and it turned the background green. So what is the significance of this? Is this in fact where the trend changed? Right here? Does that constitute a trend change, yes or no? Breaking up through resistance, blue bars, background's now green, and you're going up to a fresh swing. Is that the point? That it occurred. All right, let me give you some other possibilities. How about when it comes down here, forms a fresh swing low, and then bounces above the midband. Let's call this, I'm going to give you a couple areas to vote now that you're looking at it. I've slowed it down and we're looking at it together. Let's call this circle, oval area A. Okay. Let's call this area, and I'm trying to bring some clarity to you understanding the trend change concept. Let's call oval, the second one, let's call that B. Okay, here's B. And then we come up and we poke through that swing at A into a fresh swing high here. Let's call that area C. Now you have some granularity. You have some detail around 3 possible areas where the trend change can occur. Now I'm going to give you 5 more seconds now that you see this to cast your vote. Did the trend change occur at oval, the first one, A? And there's 5 seconds on the clock. Cast your vote now that you see the what occurred in more detail. So was the transition oval A, in your opinion, in terms of the trend change? You type in a letter. Did the trend change actually occur at oval C, or I'm sorry, Oval B, when then you now have a higher low and you bounce. So we're not talking trade entry here. We're talking TC trend change. We're not talking about trade entry just yet. We'll address that in a minute. Or is the actual confirmation of the trend change when you break the swing at oval C? Cast your vote. 4 seconds left on the clock. What, now that you have more detail? Was it A, when that swing was broken? B, with a higher low and a bounce just above the midband, and it takes that swing out one more time? Or C, when it punches through that swing established by the oval in A? 2 seconds left. Type in a letter. Cast your vote. A, boop. B, boop. C. Looking at trend changes on crude. Hour and a half into the European trading session on the morning of the 20th. 1 second left. What say you, team? Time's almost up. All right, time's up. So, look, I see a lot of different answers here, and that reflects the how all of you and different traders, and some of you listening on this recording, are different types of how you view things. If you cast your vote for A, oval, you are what are said to be an early adopter. An early adopter is a trader who it tends to be a little more aggressive and sees the changes very quickly, picks up on breadcrumbs clues, maybe a little faster than some other traders, that's not good or bad. I'm just saying everybody's different in the world. We've worked with hundreds and hundreds of traders for years all over the world, so that's the way that works. All right, if you said B, that's kind of a middle range trader adopter in the fact that it now has established. So in and of itself, you have to say, is the breaking of a swing enough to give you a trend change? Do you have enough points of contact? Early adopters would say yes. I would argue, I don't know about that. Now, when you come down here and you get a higher low and it bounces, in my view, that is the trend change right there. When it comes right back up through here and breaks that little swing area and gets precipitously heading up very quickly from here. In my view, right after B is when the trend changed, because now you have confirmation. You have several touch points here. You have established a higher low, a higher high, now a higher low. You have 3 touch points. We generally look for at least 3 touch points of higher highs and higher lows, which you get with oval B and this bounce right here. And then if you said C, that's okay. Some traders need more confirmation with a 4th touch point where this swing at A was now confirmed with a higher low. So not only did you get higher lows and higher highs here, you could make the case that this was a higher low and that this was a higher low and this was a higher high. And by the time you hit touch point B, you had firmly established a trend change. So I would say it would be B. A with an earlier adopter, C with a little bit later adopter who wants more confirmation. Now, that's a good point. Some of you want further confirmation, and there's nothing wrong with this, where you would look for a bounce higher of the midband. So, for instance, in here, the fact that you got a higher low at B may not be convincing enough to you because you're looking here at the midband, even though you have a green background, and saying, wait, hold on a minute, Charles, that thing's still flat. However, when you establish C, the midband and all the bands have started to move up. So one more confirmation point. Now, in some cases, you're going to find, depending on how quickly the market is moving, that if you took a trade entry at the bounce on B, that's the most aggressive entry right there. Now, I'm going to do one more exercise on this, and then we're going to skip to this morning, okay? Let's do one more exercise to see if you're really getting how this works. I'm going to progress through into the opening session of the market. Some of you might not understand this because you're looking at it for literally the first time, and that's perfectly okay. So don't worry about this exercise. But I'm going to take us through where the ABC ovals occurred And I'm going to advance it, recreating in the morning on the 20th for all the way till 7 a.m. And when you see a long trade, you just simply type in the letter L when you think you see a long trade entry. Okay? Ready? Here we go. Starting the exercise right now. So when you see what you think is a long trade entry on crude as I advance this chart, you simply type in the letter L. Here we go. We're going to do it together. I'm going to go pretty quick. So make sure you can stay. I'm going to go like 500 times the real speed. Starting at 1:32 a.m. Pacific. Here we go. Okay, I'm going to make the bars super big so everybody can see them real good. Okay. All right, there we go. Now we're at 1:38 a.m. Pacific. Okay, I'm going to go super fast. Remember, when you think you see a long entry, you're going to type in the letter L. Okay. Okay, here we go. Going up. Now we're at coming up, approaching 4 a.m. Pacific. We've been looking at the chart for approximately 3 hours, and it took me like, what, a minute and a half. So we're going like 1,000 times real speed. Okay, coming up on 4 a.m. Crude time. There's 4:03 right there. 4:03, 4:06, 4:07. So we're going pretty fast. There's 4:42. 4:47 crude. Okay, 4:50 coming up on 5 a.m. There's 5:02. Okay, there we go. All right, now we're at 5:30, 5:44. 6 o'clock, crude pit open. Gary's got the room open. So that was all pre-open on crudy. There's 6:01, 6:12, 6:13. Continuing to advance into the open of the pits for crude. There's 6:41. Now the U.S. equity markets are open for about 11 minutes or so. The crude pit's been open for 41 minutes. Right in here. Okay. There's 6:56, 7:05, 7:20. And there's 7:30. Okay, let's stop it right there. Now I'm going to scrunch this down and let's look at this all together. Okay? There's the whole view of what I just showed you. Now let's back it up a little bit. And I want to try to do it as best as I can to help everybody to visualize this. Let me do it this way as best I can to help to visualize how these work. So that when you're in the room tomorrow and you're in possibly early sessions or late Asian sessions and you're on your own trading maybe currency futures or other markets, all the setups we're showing on crude are legitimate on every instrument. Okay? All right. So the first long trade, which some of you got, was actually right here. Can you see how the market dipped down into the band? So a mid-band trade on the long side is defined as entering the band directly above the mid-band, and the band directly below the mid-band is considered, or of course sitting right on the mid-band itself is considered a legitimate mid-band trade. In this case, you're getting long. You're buying retracements into support. You just dip your toe back in here, you wick a few ticks above the mid-band, and you bounce. That was long trade entry number 1, and many of you got it. Now, I want to be clear about something, and this is something some of you are just going to have to work on a little bit. I want to be clear. Some of you typed in long when these blue bars formed right here. Now, that was not correct, okay? And here's why. This is the thrusting part of an up move. When you get a push in an upward manner in an uptrend, that is considered the thrust. And we never, ever, ever, as a rule, this is a very important rule that will help save you losses. We never ever buy thrust moves. We always buy retracements. The question then becomes how deep and where is the retracement to get in? So if you typed in an L up here, that was not correct. Now, some of you typed in an L when these bars formed right here. Do these bars here meet the minimum criteria to get in the trade? Yes or no? For those of you who know what I'm talking about. Right here, is that box a minimum criteria box, yes or no? It's a very simple answer. I'm not going to give you more than like 3 seconds. It's a very simple yes or no question. For those of you who know the criteria, and I'll help you in a second with it. 1 second. No, absolutely not. The definition of a minimum criteria entry on a long trade is you have to close below stealth. So yes, but you have to close bars, multiple, closing below line 6 here. Now, did that occur in this box? Did bars close down into here? You had the wick of one bar, but that actually closed up. That closed up, so it didn't close in here. So the answer was no. That was not a trade. Now, the reason we do that, just real quick, is that when we take these long trades, our goal, in this case here, would be sufficient retracement level to get back to the top. In other words, you need enough meat on the bone on this pullback here to get back to here, because that's your target. And you're just dipping down into band number 7. There's not sufficient distance here. Now, did it work out? Yes. Yeah, it has to go below stealth, which it did, and it has to close below line 6 into this area right here. So that now it worked out, and you made money if you took it. So I'll give you that. But now let's contrast that with these bars right here. Is this a legitimate long minimum criteria entry trade, yes or no? Does that meet the definition of a minimum long criteria entry in an uptrend? I'll just give you literally 2 seconds based on what we just showed you right there, right? And of course, the answer is yes. We close below stealth, check mark 1. We close below line 6, check mark 2. And we go and we engulf the area or put a limit buy or however you want to get in right in here, and you're filled right in here long. Good. Well, ideally, we'd like to see at least a couple bars. Yes. The better one is where you get clusters of bars sitting for some period of time, like you have in the mid-band trade right here. So this would be a long trade where the bars just literally sat there for, 20 minutes. There was plenty of time to take that trade. That's a no-brainer. So let's come back over here and put an X mark through the one that was not. That was not deep enough to take it. Okay. That's an Ixnay on the minimum criteria A. Stealth PS is this sort of thin, sort of snaky looking green line. We've had that for 10 years on our charts. It's called the stealth line. So it's when a market's heading up, it's green and solid and tracks the market. We mainly use it for like trail stops, to position trail stops in an up long trade. Yeah, so your trail stop would have been stopped out somewhere in here, and then you could have jumped back in. So how many did we have? We had 1, no, 2, yes, 3. Now that you see it again, how about over here, where these little dipty-doos of yellow bars down above the midband, were those legitimate buys long? What say you, team? Now that you have a chance to look at it when it's paused and not moving. So the key here, obviously, you can see when you start learning how to do this, is having enough sort of chart time and knowledge to understand that, you got to be able to see it in real time when it's fluid and dynamic and the bars are coming at you. It's easy to sit in your chair comfortably and look back and say, oh, yeah, that was a mid-band long. Now I see it was very clear. Yes. All right. So long trades here, 1, 2, 3, 4. How many of you got those? Did you get them? Did you see them all? Didn't get faked on the thrust? No buying thrusts. Here's the thrust. You didn't type in L when it was up here, right? You got to be patient. That's not deep enough. All right, questions coming in here. Previous midband after C, it did not touch line 4. Strict rules of the state. Close line 4, midband area 3. Any feedback? Not really kind of following your question there, Brent. You got a lot of moving parts in that question. Um, a mid-band trade, just to keep it real simple for you, is anywhere in. I'm going to draw a rectangle. If the bars occur anywhere within this rectangle, that is a mid-band trade. So it can be above it, it can be sitting on it, it can go into this area here. Yeah, it's that simple. If you're in this rectangle, anywhere in that rectangle is called a mid-band trade. In an uptrend, a minimum criteria trade is located in this area right here. So when you hear those in the room, you hear the term that's a mid-band trade, or you hear the term that is a minimum criteria trade. If you're in an uptrend, that is where those are located. Now, a deep retracement or a phantom in an uptrend can go all the way down into this box right here and still be a long trade. That's called a deep retracement. Yeah, you don't have to really overthink it. It's literally that simple. I mean, that's really, if you want to just sort of boil it down to the three basic trade entries in an uptrend, it's those three boxes right there. Yeah, minimum criteria, mid-band, deep retracement. That's it. All right, well, let's, we got a couple of choices here. We've covered a lot of material and blown like 3/4 of our webinar on crude. Would you like to continue and look at crude this morning, or do you want to see other instruments? Because some of you wanted to see, I know, like ES, and some of you want to see YM. A few of you wanted to see, other. Type in what you want, and I'll do it. Whatever the vote is. You want to see today on crude, or you want to see other instruments? Let's see what the vote is from the team. Keep going. Scalps and trailing stops. Okay. Yeah. All right. Okay. All right. Charts are charts. It doesn't matter. You're just showing. All right. Let's do this. Let's very quickly advance to this morning. We'll address the issue of scalps and let's get into the meat of why you're here. And talk about scalps. Scalps and runners. Let's talk about that. And let's do that. And then we'll zip very quickly. I'm going to spend like only maybe a couple of 3 minutes on this very quickly, because this morning on crude was very, very easy and straightforward to see. Now, so what we do here is we have a basic trade entry system that works off of trading two contracts, and I'm going to explain it like such. Let me show you a good example of a trade and how it can play out for targets, and this can be true of almost literally any trade that you take. And I'll show you this is the anatomy of sort of a textbook trade, whether it be long or short. Can you see how these candles come down into this area right here? And you get a candle just above the midband that comes up. Now you can use the object trader tool to enter the trade, or you can do it yourself. In the case of you putting a limit order here or an object trader region box, you'll probably fill long on this bar right here. Now if you put two contracts on, I'm going to ask a question, and you just logically looking at the chart itself, where might you want to take a scalp trade off if you have? So you enter, just to be clear, you're entering with two contracts. So you put two long on right here. Now when you think about the term scalp, what does the word scalp mean? And while you're pondering where that scalp target's going to go, object trader would automatically go 12 ticks below here, which I'm guessing would probably be somewhere in here, and put your initial stop. So this would be your stops on two contracts located right here. So your two lot stop would be here. Lot is a contract. Initial stops, okay, would be right here. Two lot initial stops, 12 ticks below your entry. So that'd be somewhere down in here. Where might you want to take one of your contracts off? of the table. Just looking at the chart, where do you think it might want to be? Well, I mean, it could be, I don't know, here, or what about here? Would that be a good place, maybe? Would you want to have it come up to this swing level right here, maybe? You want to peel one off right there? What do you think? Let's look at some numbers real quick together here, okay? Let's say you got filled at 86 long. I think we took this trade. This is 7:30 in the morning, as I recall. I might have taken this. And the top of the range is located here at 99. So you are roughly 13 ticks from your point of entry to here. Might that be where you might want to take your scalp and peel one off? So the distance is 13 ticks. Now, would you want to put your target at 13 ticks? Or might you want to come inside of there a little bit and go maybe 10 ticks? What do you think? So 10 ticks would be somewhere like maybe right here. Where do we say you got filled? 86-ish? Okay, so 96. So yeah, there would be your... Would that might want to be your scalp? 10 ticks? Right. So I'm showing you the example, and of course, if you were taking a short, the inverse of that would be the short trade. So you would short 2 contracts. Remember that downtrend I was showing you on the boxes? Remember on that? Okay. So you would get filled out of the box. In the case of the short, you want to get back to a swing that's at the outer one down here on the short side, right? So you get short, and you want to get that swing. The swing is normally down, right, sort of at the bottom of line band 1, right, down here. Now, when you engage the trail, so this is one cancels other. So what happens is that if you're using the object trader tool, or you can do it manually, once you hit your scalp target, you only have 1 contract on, so there's no need to have 2 stops. So what happens is we take 1 off, so there's 1 left, and we take this within 3 ticks of our entry. You can do it manually, or Object Trader can be programmed to do that automatically for you. Now, why don't we just take it right up here on where we got in? Or for that matter, why don't we take it just up here, 2 ticks above where we got in? Why don't we do that? Why don't we do that? Why don't we just take the stop right here? Why might we not want to do that? Just take it right up right here. We just make sure we're not going to lose 1 penny on this trade. Not 1 penny. Account size should allow for 2. I don't know any trading, well, unless you only have like $1,000, and then you could do micros. You can do this with micros. Micros are the little micros that are 1/10 the value of the full E-mini contract, and I'm sure everybody can do at least 2 of those. I mean, it's like a dollar a tick. Now look at what happens here. Now, if you had brought in your very aggressively taken your trail stop right up to your point of entry, or slightly higher, when this pullback occurred right here, what might have happened to your stop? Right here. What might have happened to it? Probably got it. Probably got it if you were very aggressive. Now, what if you put it here? What if you left it 3 ticks behind your entry, something like that? Actually, that would be like right there. Would that have taken you out? No. Now, is it okay to go 3 ticks behind your entry? Well, let's think about it. You've already made 10 ticks here. So even if for some reason some funky tweet came in and the market freaked out, or some country got bombed or whatever in the OPEC, and the thing just ripped, crude just freaked out, would you still make money on this trade? Yes or no? If you do it just like I'm showing right here, would you still make money on the trade? Yes or no? If you have a 1 lot scalp at 10 ticks, you come to 3 ticks within your entry, the market freaks out, takes out your stop at 3 ticks, you still netted what? 7 ticks. That's called a free trade. So if you conceptualize taking these trades and just think about it and look at the markets and how they move, you want to always try to get yourself to this position of having a free trade in place, where you've gotten your stop, your scalp target has been taken out. You're down to one lot, or you can double this up. You can do 4 and 2, and then trail 2. I do that a lot. You can do 6, 3, trail 3. However, I'm just showing you an example. Now, what do you do as the market then continues to move up in your favor, because you're long from here, like such? What do you do from here? Now, this is your runner. You got your runner sitting here. Now, what are you going to do? How do you manage that pup? What do you do? What do you do on that? What do you think you can do? You trail it, and how do you trail it? Well, let's look at some possibilities here. Let's go back and think about the stealth indicator. What's that doing? Is it following the price as it continues to move up? Yeah, pretty closely too, huh? That's good. How about line 6, this thin red green line right here? Is that following the price up? But a little bit further away, right? Right, you can keep it just below the stealth line. Now, each instrument's a little bit different. I want to be clear about this, okay? There are times when, if you're going to trade NASDAQ or Russell, for instance, that you're in a long, protracted uptrend, and you'll get little wicks where it'll wick that stealth line. Okay, it'll wick line 6, and it'll just have a little spastic, little kind of pullback. In the case of those instruments, you're going to want to fade it a little bit, give it some wiggle room on a big move. Okay, you're going to keep it like behind it a little bit, couple ticks behind it. Let it move up. Let it move. Stand by. 1 second, please. Sorry about that. Happy wife, happy life. Sorry about that. Sorry about that. I thought I had it turned off. Okay, so let me, yeah, so that's a good question, Kurt. Now, in the room, you might hear things like tight or loose. Okay, so let me just clarify what that is. Okay, on the tight stop will more or less always be where the stealth line is at any given point. In the case of the move up here, I might say something like if you're long from crude from lower levels, the tight stop would be at 58.04. So what that means is when it closes below stealth, as it did right here, it will stop you out. In terms of trade management, when a market hits a swing level and starts to pull back, you will notice that your P&L starts to go down. That's called drawdown at the end of the trade. Drawdown at the end of the trade is where you're up 180, you're up 190, 210, 220, but whatever, 240, 250. Oh no, now it's like 220, 210, starting to drop. So that's called drawdown. What's happening is the market is pulling against you as it retraces, where there is profit taking on all the market participants that were long from lower levels. They're taking profits just like you are. Now, the way to lock it in the tightest is to there's 2 ways, the tightest ways to get out. If, in fact, this level of 58.13 turned out to be a very strong resistance level, and as an example, Gary had a line right there, as we did with the gold shorts this morning. Remember, it came down literally within 2 or ticks of his line. Remember that? And we said, you want to get out here, there's going to be some short covering, and we were short 2 lot, and you want to pull 1 off. So say there's nothing wrong with taking profits at a swing. In the case if you're trailing 2, you would peel 1 at the swing and then trail the rest. If you have a 1 lot, you can just put a sell order and just dump or market sell and just get out of it. You see that? Yeah, right there. Now loose would be somewhere underneath or at line 6. Now, I might say, or Gary might say something like your loose stop would be 58.01, and you can fade that by a couple of ticks. So what we're talking about there is the case where maybe you were on line 6, it would have obviously taken you out. If you were below line 6, somewhere in between the midband and stealth and line 6 with the loose stop, this could have been one continuous trade. See, and then it continues up. So those are loose. So normally loose would be 6 and or fading it by 5 or 6 ticks. And then you trail up and catch the last part of it here like that. All right, that's good proper trade management. Okay. All right, I think that has covered everything we wanted to cover tonight. Let me see if I can squeak in a quick. Let me see if I can pop up a ES chart real quick. Take a look so you know what's going on here. See if I can get. I know we're right at 6 o'clock, but maybe I can squeak a couple quick ones in here. Don't lock up on me, ES. Yeah, you're welcome, Gene. Thanks for coming, everybody. Let me just see if I can pop a couple more things up here. Occasionally, I'll look at divergence. Dave, today was an example this morning, actually, shortly after the open, where the equities were dropping. Nasdaq led the sell off. YM quickly followed the Russell, and ES had those beautiful 3 shorts. And gold was going down. Now that's very rare. So we look at correlations of equity markets between each other. And, in other words, of the 4 markets that I watch, and 2 of which are in the live room, the Russell and the ES, we look for convergence between those. And we know sometimes what will happen is YM, Russell, or NASDAQ will lead a trend reversal or a push down or up. Now, in the case of the open on the ES, what kind of trades were we looking for here? Well, we got the initial break off of here. This is the initial breakdown. Gary had a line, and we got short under this support level right here. And I can't break all these other charts up here, but I think I showed this in a little thing this morning for some of you. Why we took this short was because all the other markets, Nasdaq was ripping. Nasdaq was down like 80 points by the time that box formed. Russell had broken, and YM was selling off like a big dog. So that was a legitimate short trade right there. The only thing that wasn't in confluence when we took that short was the gold was dropping. Now, where else, if we missed this initial entry on the box, were there other places to get short on ES here? What say you, team? How many other short entries are on here between here and here? See if you can see them. Between here, and not including this one. Okay, we're saying if you miss that one, which is totally okay. It's like missing like a plane or a bus or something, right? There's always another one coming along. And right here, how many more short entries were there on ES? What say you, team? Counting shorts. I'll give you 5 seconds based on what you know on mid-band minimum criteria and deep retracement shorts in a downtrend. 3 seconds. 2 seconds. Counting shorts in between these lines. From here, not including this one, and over here. 2 seconds. Cast your vote. Just type in a number. 1 second. Counting shorts. They can be mid-band, minimum criteria, or deep retracement counting shorts. 1 second left. See if you can visualize them. That's all part of how we do take the trades. You got to visualize. You got to see when it sets up for you. I didn't want to do this real time because we're running out of time. All right, time's up. So here we came down, and if we use our, I'm going to first speak to this trade entry from a scalping running point of view. You can see very clearly here that your scalpy was filled before you got down to the bottom here. You could have very easily taken 6, 8, 10, or 12 ticks off when it got down to the swing down here. That's what you want, right? That's scalpy. And then if you use stealth and or line 2 as a trail stop, somewhere in here you got taken out. Probably somewhere in there. In fact, I think we called an out there for a trail with a tight stop. So you're out of trade number one. Now, looking at the chart here, do these bars right here meet the definition of a minimum criteria trade? Yes or no? Well, let's look at it. You're closing above the stealth line, the red one, so that check mark in box one, number one, and you have to be above line 2, the thin red line here, which you do. So yes, right. Yeah, that's legit. Now in this one here, you got your scalp off, right? You got your scalp off here, and then if you had tight stops on your runners with the stealth indicator, the close of this bar took you out on the runner. So the runner didn't give you much. You maybe got 6-8 ticks on your runner. So that was a stop out right there. Now, how about, there's a final question here, and then we're going to wrap. And you'd cast your vote. Are these bars right here considered a mid-band trade, MB, 5 seconds on the clock, or minimum criteria, MC? The box here with the yellow bars in it is considered an MB, mid-band trade, or MC, minimum criteria. It is a legitimate short trade, so it's one or the other. You cast your vote. 4 seconds left. MB, mid-band, as defined in the downtrend. 3 seconds. Cast your vote. MC, minimum criteria, short. 2 seconds on the clock. What say you, team? 1 second. Look at where they're at, position-wise, in regards to the bands. That's how we classify them, right? That's how a trade is clearly identified. 1 second. Squeak it in. Some of you are still learning. That's okay. You can guess. It's not going to hurt anything to guess. We're all friends in here. We're all trying to learn and share together. No problem. All right, time's up. Well, let's look at it this way. Let's come back and over and think. Let's think about in a downtrend how we classify our trades. I think we said that it was the band directly above and below the mid-band and on it that constitutes a mid-band short, right? And it's the reverse of the uptrend, right? So a deep retracement in the case of the short is way up here, right? And then the minimum criteria occurs in the band of right here. Minimum criteria, mid-band, deep retracement when you're in a downtrend taking shorts. So now that you know that, the bars fall into where? The band directly underneath the mid-band, so that is an MB mid-band short right here. Mid-band short. That's it. This one was a minimum criteria by definition, right? That's it. That's a minimum criteria. This is a mid-band. See the difference between the two? And of course, you're filled on the close of that bar right there, out of the box, right here. You get your scalp off at the swing. We engage the trail using stealth or slightly fading stealth as it descends in your favor. Now, when I say fading it, what we're talking about is coming slightly above. The stealth tight stop would have been taken out here, just to be clear, so everybody's on board with what we're doing. In other words, if you use the stealth line, the close above stealth with the tight stop was taken out right here, okay? If you faded it a little bit on line 6 and you kept it loose, hence the loose stop, you could have handled this retracement and it wouldn't have wicked you out, and then you would have been taken out probably somewhere down here. There's only a few ticks difference in the two, all right? In other words, you caught sort of this little last leg down, and then it ultimately took. So the two stop outs were not that different, really. Okay, so that was leg 2 of the run for the runner on the third short. Got you either there or, down here. Either one. You were taken out. So by 7:45, we were done. If you recall, when this box formed right here, I said I was not going to reshort that. You remember in the room? Remember I said, sure, this is a legitimate mid-band trade, but I didn't take it. And you arguably had another one right here. Now, you did not take it. Why does anybody who was in the room remember why I did not take those? What was going on? Let me give you a little clue. What were the other equity markets doing when those two boxes formed? Anybody remember? Were you in the room? You might remember. What was the Russell doing if you were looking at that? What was NASDAQ doing? What was YM doing when those two boxes had formed? Anybody remember? It was in the room? Yeah, they were going up. They were ripping. You remember the Russell chart? That thing was on fire. It went all the way back up to where it broke down and then some. Spazzy was going nuts. I was telling you in the room, right? That thing was on fire. YM was smoking. So when the other equity markets are going up like this, do not step in front of the freight train and try to reshort that. That's why the correlations really make a big difference. Remember? And then gold dropped, and then we covered, and then gold took off, and the other markets rolled over, bear food, and then they just tanked. ES was just dinking around here, so it turned into dead money because it just gets manipulated a lot. A lot of big money pushing. I mean, look, if you look at these bars, if you ever look at this, these bars are significant. I mean, above here, these bars are all over 5,000 contracts each. That's big money pushing this around, okay? Big algos, $100 million algo plans by the big boys pushing this market around. Very liquid, 1.5 million contracts a day. It's the most liquid contract of all the futures markets. Sometimes the equities will correlate with crude oil. In the old days, many years ago, like a couple of 3 years ago, they were tightly correlated. If oil was going up, you could pretty much bet on the equities going up. Nowadays, not so much of a correlation. So that's all changed. The algos have changed over time. But normally, if equities are going down, gold's going up. I've shown that correlation 1 million times, and I'll show it tomorrow morning in a trade recap. Okay, I've gone way over here. My apologies. Let me turn the recorder off. Thank you for sticking